Hi everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're diving into Oil-Dri Corporation of America's recent report. It's not exactly a nail-biter thriller, but it does give us a peek into whether this kitty litter and oil absorbent company is cleaning up or getting buried in the dirt. Oil-Dri Corporation of America just released a report about their recent financial performance. In short, we'll see if they're making money or losing it, and we'll see what big changes are happening. It is crucial to understand this information when considering this company. First off, let's jump to the part where they talk about how they're doing financially. This section tells us if the company is making more money or less money compared to last year. We want to see growth or at least stability, not shrinking profits. Luckily, they attached a press release with the details. Press releases can sometimes be a little too optimistic, so we'll read between the lines. But it gives us the headline numbers. They also announced something important: dividends. Dividends are like a company sharing its profits with its investors. If a company is paying dividends, it's generally a sign they're doing okay. If they stop paying dividends, that could be a red flag. The board declared quarterly cash dividends of $0.155 per share of common stock and $0.1165 per share of Class B stock. The dividends will be payable in May 2025. So they're still paying out, good sign. This means the company is making enough money to keep shareholders happy. Now let's dig deeper into those earnings numbers. To get the full story, we need to look at the exhibit they mentioned, the earnings press release. This is where we'll find the actual numbers that tell us how Oil-Dri is performing. Okay, net sales for the second quarter of fiscal 2025, which ended in January, were about $94 million. Now, is that good or bad? We need to compare it to last year. It seems like this is slightly down from $96 million last year. A small drop, about 2%, means they sold slightly less product. Gross profit, that's the money they have left after paying for the stuff they sold, was $24 million. Last year it was $25 million. So similar small dip here too. But let's find out if their costs increased. Selling, general and administrative expenses, basically the cost of running the business, went up. They spent about $21 million last year. Increased costs can hurt profits, even if sales are okay. Let's summarize these financial results. They sold a bit less, their profit margins are a bit smaller, and it cost them a little more to run the business. All of these things together lead to profits being lower overall. This might be due to changes in customer behavior, increased competition, or just higher costs for materials. To find out if there's a specific problem area, let's look at their different business segments. They have two main segments: consumer products and business-to-business products. In consumer products, which includes things like kitty litter, sales were $73 million. That's down from $75 million last year. People might be buying less kitty litter or switching to cheaper brands. The business-to-business segment, which sells absorbents for industrial uses, had sales of $21 million. That's about the same as last year. That part of the business is holding steady at least. Now, what does the company itself say about the future? Let's look at their outlook. This is where they tell us what they expect to happen in the coming months. They might talk about new products, challenges they see coming, or changes in their strategy. Looking ahead to the third quarter of fiscal 2025, we expect to see improved profitability. That's good news. They're hoping things will get better. They also mention operating efficiencies and lower raw material costs. Basically, they're trying to cut costs and get better deals on the stuff they need to make their products. This is a good sign that they're actively trying to improve their business. Okay, we've covered the key highlights from this report. We saw slightly lower sales and profits, but the company seems optimistic about the future. They're working on cutting costs, which is important. So what does this all mean? Looking at Oil-Dri's situation, they seem to be facing some challenges in their consumer products segment, maybe from increased competition in the kitty litter market. But they are not sitting still. Their business-to-business segment is stable, and they are actively trying to improve their profit margins by cutting costs. This shows they have a plan. A big thing to watch will be whether their efforts to cut costs actually work. If they can get their expenses under control, they could see their profits rise again. If not, they might need to rethink their strategy. Overall, they seem like a stable company with some headwinds, but nothing too alarming. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate deep dives.